oracles. Well, what can we expect from the market this week, the week of December 2nd, 2024? So, this week, coming out of November, coming out of the Thanksgiving season, we're now looking forward towards Christmas and Hanukkah and all of the other gift giving holidays that we have coming up. Well, we usually at the end of the month will get a Santa Claus rally, but what can we expect heading into that Santa Claus rally? Well, this week alone, we have a lot of jobs information that we're going to be getting out. We also have tax loss harvesting is going to be starting. Now, tax loss harvesting is when companies and institutions and investors take losses on stocks that they owned so that they can write them off on their taxes and offset some of the gains that they made over the course of the year. Now, this year alone, we saw a massive run in the stock market. So there's a lot of gains that have been made this year. So we're going to see that tax loss harvesting to offset that. Now, a lot of times institutions will try to get ahead of the game and they'll take it early in the month. The reason they take it earlier in the month is because of the fact that there's the 30-day wash rule. And the 30-day wash rule is they can't offset any of those gains and they can't take the losses on those if they sell it and then buy it back within 30 days. So once they sell it, they've got to wait 30 days to be able to avoid that wash rule. Now, the reason they do this is a lot of the companies out there that they're owning and they're selling, maybe they actually do like these companies long term and they just did not have a very good year or a quarter or whatever it is. So they're going to be taking the losses in that and knowing that a lot of other institutions are going to be doing the same thing, hoping that maybe in 30 days they can buy it back at a lower price and then ride it out more long term from there. So that is what their strategy is going to be. And they try to get ahead of the game and do it earlier in the month. So this way, when we get to the new year and we get that Santa Claus rally, then we catch the end of that Santa Claus rally going into the new year, they can catch it at that point and catch some gains early on. So that's a strategy that a lot of these institutions use. And we could be seeing some of that starting this week alone. Now, with the jobs data coming out, that could be another trigger that could cause the market to sell off a little bit. And now, as we know, the market has been looking very strong, but we've seen times in the past, like the great financial crisis, where the market looked really strong as well, but the underlying data and the underlying foundation of the economy was not as strong as a lot of people thought it was. And that's kind of where we're at right now, is there's just a lot of uncertainty and there's an opportunity and the chance that we could get through this without any issues, but there's so many little things that are going on where one little piece is in the wrong place and it could cause a collapse going on. The jobs data is one of those most important pieces right now. And while we felt like we had inflation basically squashed entirely with the Fed cutting rates, inflation is kind of stalled out where it's at right now. And with Trump talking about putting up a lot of tariffs out there, that could increase inflation as well for next year. So while unemployment was the biggest focus for the Fed, looks like inflation is kind of rearing its ugly head. And when we get to the next FOMC meeting, we might not get a rate cut at all, and the Fed might just be pausing from there, leaving rates at a higher rate where we're at right now. So again, there's just a lot of uncertainty still in the market. And again, the jobs data is one of them, because if we see ugly jobs data coming in this week, the Fed's going to be really torn about, hey, we see inflation not really kind of keeping itself down and kind of getting stuck where it's at, but we also have unemployment creeping back up. Unemployment creeping up means the Fed should be cutting rates. Inflation going up means that Fed should be going up on rates or pausing. So they're going to have some very difficult decisions to make if we see some ugly jobs data this week. Now, specifically, we have the jobs opening data coming out on Tuesday. Last month, we had 7.4 million job openings. So we'll see what this month's number is going to be looking like. And again, going into the holiday season, we're kind of expecting higher numbers. I don't have an expectation or an estimate right now, but you're looking at kind of higher numbers that we should be expecting for the holiday season from holiday hiring. Now, they do end up taking those numbers out and seasonally adjusting those, but we'll see what those numbers are going to be looking like, because if those numbers aren't as strong as we're expecting, that could lead us to some concern. Now, again, we've talked about it before, and my anticipation is we're going to get the true jobs data for the holiday season and what the holiday numbers look like when it comes to revenues right around the time that Trump is going to be inaugurated on January 20th. So when that happens, we could be getting some underlying indicators right now that maybe the market kind of puts up as a red flag, but just ignores for the moment and then really reacts to it in about a month and a half from now. So just one of those things to pay attention to, and just take it as a data point to put on your records, just to say, hey, this is what it looks like. What can we expect going forward? And to not be shocked if the market is not reacting to it now, but reacts to it more heavily later. The next number we're going to be getting is Wednesday, the ADP report. The ADP report shows us job growth. Last month, we had 233,000 jobs, which was significantly higher than the expected 115,000. Now, a lot of that was government jobs that were put in there. And again, these numbers have been getting adjusted down heavily over the last couple of months. So take this one with a grain of salt as well, because a lot of times the government creates a lot of government jobs to kind of make the number look better and give people jobs, which is great to give people jobs. But reality is those jobs aren't really creating any growth in the economy. They're really more of a drag on the economy. Not to take anything away from those jobs or those positions or those people, but what ends up happening is it's an expense for the government when you're looking at it from a business standpoint rather than an income source. And when you have more expenses than income, that is a negative situation that you've got going on. And right now, we obviously know the government is struggling to even just pay its interest on its loans, let alone the loans themselves. So bringing on a lot of government jobs is not the best idea when it comes to trying to get the government's finances back in line. This is something where, Elon and Vivek are coming out to work on with Doge, the Department of Government Efficiency, to try and trim some of that. We'll see how that all plays out. And again, I think that could be something that leads to higher unemployment next year, thereby causing a recession for next year. But it could be one of those weird recessions where we have a higher unemployment number, but those people who are unemployed actually do have income coming in, thereby offsetting a lot of the negative effects from a recession from all of the unemployment. And we could still see some better GDP numbers. But again, a lot of that is uncertain for next year because then you have to factor in all the tariffs that may be coming or maybe not coming. Lots and lots of unknowns. And again, the one thing that the stock market likes the least is the unknown. So we will pay attention to all of this going forward for next year. But for this week, looking at that ADP report, again, for this one here, I don't have any estimates yet as well. But job growth is one of those numbers that it's not so much GDP, it's not so much what the stock market is looking like. When you're looking at whether an economy is healthy or not, it is jobs growth. That is a very important number. If you are growing the jobs number in the economy, you are growing the economy. Bottom line, that's it, because more people have money coming in, more people can spend money. So that's going to be very important. And yes, that goes back to the government giving people jobs, which does spur on the economy. But when you do that too much, it's not very good for the economy itself and the underlying business standpoint for the government itself. So again, ADP report coming out on Wednesday. And then on Thursday, we have the jobless claims coming out. Now, that does come out on a weekly basis, but jobless claims coming out will also give us another indication because when you're looking at, again, the seasonal hiring where, a lot of these retailers are saying, hey, we just need somebody to stock shelves, somebody in the back room, whatever it is. When I was in college, I got one of those jobs in the mall as well, just to help somebody in the season. It was a 4-week job. Those still are existing out there. Maybe it could be UPS, just loading up the trucks, whatever it is. These seasonal jobs are going to be important because when you're looking at those jobless claims, maybe there's people out there who are unemployed, but they're like, hey, I'll take a seasonal job on just to get that extra money that's coming in. And this way they're going to be doing that. And that could lower those jobless claims reports. We'll see what that number looks like this week on Thursday. And then Friday is the big number. That is going to be the unemployment and the wage growth. So again, looking at wage growth, you want to see wages going up, but not too much. Because if wages are going up too fast, that could cause a wage price spiral. And that means that inflation goes up, wages go up, and we just keep seeing up and up and up and up. And we just keep on seeing that going out of control like a tornado. And while it's great to see the wages going up, when the prices continue to go up, it just offsets itself. And those wages going up mean absolutely nothing. And you just take the dollar, and that's where inflation kind of blows it out of proportion. And you see the inflation numbers going way too high. And then you get into a situation where you saw where Venezuela was, and the dollar ends up becoming worthless because there's so much inflation out there. So we don't want to see the wages going up too much. You want to make sure it's going up just a little bit or staying steady where it's at and in line with inflation. So that's a number that we're going to be paying attention to on Friday as well. So again, a lot of different jobs data numbers coming out this week. And that's going to be important because, again, if we're seeing tax loss harvesting starting, maybe there's going to be companies out there seeing these numbers and deciding to start that tax loss harvesting sooner because of these jobs data numbers, knowing that we could be getting some uglier times later on next year into the January timeframe. And again, they know all the data points and all the numbers as well, because when you look a month down the road and you're going to be getting these same jobs data numbers coming out in the first week of January, if we get another negative number coming out, that could cause the market to pull down even further. That hits their 30 days for the wash rule. They can then buy in at a much lower price for these companies that they're selling out of now that they want to buy back into at a later date. So just looking at timing of things and looking 30 days down the road instead of 1 or 2 days down the road is very important. And again, a lot of these institutions and long-term investors are looking very long-term. They're not looking a week, a month, or a year down the road. They're looking multiple years down the road, and they're trying to position themselves now for that long-term run. And so the positions that they're working themselves out of right now are positions that they've probably held for at least a year, because when you hold them for a year, you get taxed at a lower rate because it's a long-term tax rate. So again, a lot of different factors work into how these institutions play all of these things out. So they take the loss on it, wait the 30 days, buy back into it, and they're planning on holding it for at least another 365 days to be able to work those numbers there, because when you're working with larger numbers in the millions and billions of dollars, taxes can really have a massive effect on your portfolio. So that is one major factor that they take into it. And it's one of the things that I've really started looking at for myself in my own portfolio is taxes. Now, when it comes to my own finances, I've looked at this as well, because at the end of the day, how can I work myself down to a lower tax bracket? How can I have a lower taxable income at the end of the year when I file? And that comes down to having a side hustle and different things that are worked in by having the house, having a tenant, lots of different things that you can do, and always check with your CPA for your own personal situation. But taxes are huge, and the less taxes you can pay, the better off you're going to be at the end of the day. Because for me, I get taxed at a much higher bracket because of my job. And so, for instance, last month I got a large commission check and I lost 30% of that commission alone to the government. I'm like, man, it's so disheartening working my butt off the way I did to only get 70% of my paycheck. It's very frustrating. So at the end of the year, how can I offset that to be able to pay less taxes and keep more of my own money in my own pocket? So institutions do this, and I'm doing it for myself as well. And again, everybody's individual situation is different. So make sure you check with a CPA or an accountant to make sure that you're doing it properly and legally for yourself. But these are little things that I'm helping other people out with as well when it comes to getting themselves out of debt, is just giving them ideas of the things that they can ask an accountant or CPA to figure out, hey, what can I do to offset some of my tax losses to be able to keep more money in my own pocket? Because at the end of the day, a regular job, while it's great to have a regular job, it's the main source that people have to bring in income for themselves. That's going to get taxed more than anything. So you're trading your time for money and getting taxed heavily on it, keeping less of that money in your pocket. So the goal is to be able to get your money to work for you, so that at the end of the day, when your money is working for you, you can then get taxed less on all of that money. And there's little different tricks that are in there. And if you guys are interested, I am opening up my book on Wednesday evenings from 6:30 p.m. to 8 p.m. Eastern time, and on Saturday mornings from 9 a.m. to 1 p.m., just to help people out. And it's all a free 30-minute session to help kind of give people a very baseline strategy and give you guys a spreadsheet that you can use to be able to track your own finances. And if I can give you all the information you need to get yourself on track, to be able to get yourself into a better financial situation, cool, take it. That's what I'm looking for, is to help you guys out. And then if you want accountability going forward from there are rates that go along with that. And I can give you guys accountability on a monthly, quarterly, or yearly basis, whatever is best for you. So again, this is just something I want to provide from my own wisdom that I've done for myself. And this is where I got myself from a $600 portfolio to a $60,000 portfolio in just 4 years. I went from $75,000 in debt to a now $225,000 net worth in about 8 years. So I want to share this wisdom with you guys. I'm not a financial advisor. It's just stuff that I've done for myself, and I want to be able to share that information with you guys. So if you're interested, please just reach out to me. I've got my email in the profile on this channel. So that's all I've got for you guys. Let me know what you think we're going to be getting for the jobs data this week. Do you think we're going to start seeing some tax loss harvesting starting? Let me know what you guys think is going to be going on for the market in the next week. Thank you guys so much for watching. I appreciate all of your support. Have a great one.